welcome to Business Today. I'm Siddharth Zarabi, and today joining me is one of the most prominent market gurus across the world and a very well-known name in India as well, Chris Wood, the Global Head of Equity Strategy at Jefferies. Chris, a very warm welcome to this conversation. I'm going to begin by recounting for our viewers the fact that we are now in the 13th month after the Nifty had hit an all-time high and we are still at a low. There are various reasons that are attributed to this. How would you qualify the current situation, and why do you think the Indian market is in the current state?
Yeah, well, I don't have a very to me, actually, the Indian market is just this year experiencing what I would call a healthy consolidation after, very significant gains in the previous years. And to me, this is not a disaster. This is quite healthy on a medium-term basis. But obviously, here in India, there's a lot of focus on the relative situation because India has gone through its worst underperformance relative to other emerging markets for many years. But this is not because India has collapsed. It's simply because other emerging markets have rallied from very low valuations. So to give you a practical example, China was trading at the bottom end of third quarter last year at about 7-8 times earnings. India's on 22 times earnings now today. So it's partly a question of other markets just rallying. Yeah, so to me, to sum up, it's healthy consolidation.
Chris, how long do you expect this phase to last? Because we have seen several changes both on the growth front and the tax and consumption front. What's your view how long this phase is going to last?
Well, first of all, for now, there's one. I think right now we've got a sort of natural kind of dynamic where the market is sort of trading sideways because there are still high valuations in India. And basically that is still encouraging corporates to raise money. And it's also encouraging long-term investors such as private equity funds to sell stakes. So the supply continues to hit the market. And that is putting a natural cap on the market's upside. But the positive point is these very resilient inflows into the domestic asset management industry are basically absorbing that supply. So it's basically a kind of netting each other off. So I would expect that dynamic to continue for now, because based on my discussions with my colleagues here in India, the supply calendar is still coming. So to me, to have a real meaningful pickup in the Indian stock market next year, you need the markets, at least the expectations of a pickup in nominal GDP growth to be fulfilled. Because one negative for the Indian market this year has definitely been a slowdown in growth. And I'm focusing from a narrow stock market standpoint more at nominal GDP growth. Because at the end of the day, companies report earnings and profits in nominal terms. And a year ago, I would have said, if I'd been on this program, that the assumed trend range for nominal GDP growth in India is in the 10-12% range, which would have been most people's thinking. And the reality this year is that growth for a period has declined below 9% nominal growth. So I'm expecting or hoping, as are most people, a pickup in nominal growth towards the 10% level during the course of next year on the back of these various stimulus measures taken by the authorities. And if that happens, that should translate into a pickup in earnings growth, say to 12%, as opposed more like the 5-6% we're seeing this year. And that should lead to an equity market rally. However, if I'm wrong and we still have the same level of nominal growth in 12 months' time as we have now, that will be a surprise to the market, and it will make people start to question, is there a structural growth slowdown going on? But that is not my base case, because I can explain the slowdown in nominal growth this year as a consequence of the monetary tightening we saw throughout, but both monetary tightening and credit tightening we saw throughout 2024.
Okay, that's a fair assessment. A couple of points to follow up from what you said. You spoke about domestic inflows. What about foreign inflows? What could meaningfully drive FIIs back into the Indian market?
What would drive FIIs back into the market? The most quickly way you'd get FIIs back into the market is if you suddenly saw a very sharp correction. So let's say for the next 3 months, there are no domestic inflows into the Indian market. That just stops. That would be a negative shock to domestic sentiment. The Indian market will correct sharply, particularly they still try to launch a supply, and then that will be viewed by the foreigners as an opportunity.
Absolutely. There's one more point that is being discussed in the domestic context, and these are the high levels of capital gains taxation on various asset classes. And what a lot of domestic analysts say is a very high tax regime as far as stock markets are concerned. Uh, have you ever looked at that, and does that, according to you, feel like a sore point as far as the overall market trajectory is concerned?
Well, the long-term capital gains is what in India? It's not that high, is it? I don't believe.
I
So
think the reference, yeah, go ahead.
I think the short-term capital gains tax is definitely, I think, a bit of a negative. I have to admit that, yeah. And
Okay.
yeah, because there are many markets where there's no capital gains tax. So from a foreign investor standpoint, yeah, that is a negative. But it's more a negative for people doing short-term trading than people taking long-term positions. But I would say that's a negative. Another negative, curbing foreign investor inflow into India has always been there. That's the whole FII system. You have to register, get FII approval. This sort of process does not exist in most emerging markets.
Absolutely, Chris, and that is definitely a point to keep in mind. I want to come back to the other point and uh, ask you, in your reckoning, do you think the most recent indirect tax cut, which is essentially a gamble that domestic consumption will take care of some of the hit that we might get on account of Trump's tariffs, do you think it's going to support growth? And if so, to what extent does your analysis factor that in?
Well, no, I mean, I think one of the positive consequences of Donald Trump's 50% tariff agenda for India, which, by the way, I would never have predicted, is that it's clearly accelerated what was coming anyway, which was the simplification and lowering of the GST rates. And the government's clearly hopeful that those cut in rates will pay for themselves by a pickup in activity. So to me, that's a reasonable, expectation. So I think obviously we had the income tax cuts in India in the budget, but I think the GST combined with the monetary easing should, by all accounts, lead to some pickup in in the first half of next year. And clearly that's what domestic fund managers have been betting on this year, because what you're seeing in terms of domestic fund managers' activity is that there have been, since the budget income tax cuts, they've been basically selling what I would call capex play stocks and buying consumption plays.
Absolutely.
And that GST news has just increased that sentiment.
What about the sentiment if India and US were to overcome their trade difficulties and come up with a meaningful trade agreement, which would also take off the 25% Russian penalty and perhaps move the first 25% to a lower rate? Would that make a difference to overall sentiment, Chris?
It would create a lot of new noise in the media and help the sentiment, but in reality, it's much less important for the stock market. And that's why the stock market didn't correct massively on that 50% news, because most major listed companies are not directly impacted. And at the end of the day, India is a domestic demand-driven economy. So to me, that's more about sentiment. But look, if these 50% tariffs are still in place this time next year, then there definitely would be negative consequences in the economy because the feedback loop caused by the problems encountered by the small and business, the SMEs who are definitely hit on the 50% tariffs. So to me, it's all about how long they're in place. The latest noise suggests that there's got to be a significant chance, put it at least 50%, that we get some sort of a resolution of this much sooner than 1 year, more like weeks or months. But I think there's certain red lines India won't compromise on, which the most obvious is agriculture. And on the Russian oil issue, I don't believe the Indian government will compromise in a way that it looks like they're doing what the US has ordered. Now, if it turns out that this decline in oil prices was seen in the markets recently lead to this Russian discount disappearing, then clearly there's room for the Indian government to reduce Russian purchases of oil. But I don't believe they want to be seen to be in a position of agreeing to do something that the US has ordered.
Absolutely. The pressure factor is a very, very key issue as far as the broader trade policy and strategic component is concerned. Before I move on to sectors, Chris, just for the benefit of our viewers, under what conditions might you move from a marginal overweight to a neutral or underweight or overweight for that matter, as far as India is concerned?
No, I think the nearer we get to the end of the year, the more it may well make sense to look to raise weightings in India because one's hoping for a pickup based on these various easing measures we're seeing this year. Plus, the more other markets rally, there's a reason to take profits because, as I said, the big factor of the outperformance is not that India has done disastrously; it's that other markets have rallied. In the big picture, this is a positive year for emerging markets, which is good for India too, because it means all emerging markets are likely to receive more inflows. And my big picture view is that the US has made an all-time peak as a percentage of MSCI All Country World Index on December 24th last year. That's been my view since the start of this year. And so far, despite the US market trading record highs, we remain below the all-time high reached on December 24th last year, when the US peaked at 67% of world market cap. That's a huge percentage of world market cap, given that the US is nothing like 67% of the world economy.
Absolutely. Chris, gold and the rally is something that everyone's been tracking, and it's clearly driven by concerns about the US economy. What's your own reading about gold, particularly in light of how the economy has been performing despite concerns about the kind of retail impact higher tariffs would have had on US consumption?
Yeah, no, I view gold, this gold bull market. Well, we've been in a long-term gold market for some time, but the gold bull market really got momentum in early 22. And what's driven this gold bull market so far is buying by non-G7 central banks, including India's central bank, of bullion as a reaction. And this buying started almost coincidentally, not coincidentally, to the day as the Ukraine war broke out, because it's become clear that the world at large outside G7 was shocked by the decision to freeze Russia's foreign exchange reserves. And since then, central banks outside G7 have been buying bullion on a net basis every quarter, as a result of which gold is now a bigger share of official foreign exchange reserves than the euro. So that's the key driver of gold's performance. More recently, we're seeing more retail participation in the Western world. And the fact that the Fed is going to cut rates today by most likely 25 basis points, and the Fed is cutting rates when the inflation remains not unsignificantly higher. I mean, it's basically clearly still higher than the 2% target on a year-on-year basis. So the Fed is in the process of basically is going to fudge its inflation target, and this move will be rationalized by the weakness in the labor market. But while the labor market is weakening, it's more a question of jobs being hard to find than because we're seeing massive layoffs. So I think gold, gold remains a hedge on my base case, which is the dollar is in a long-term downtrend. So my global equity portfolio, I have a 10% position in gold mining stocks, which have been rallying dramatically of late because they've been underperforming gold. Normally they would outperform gold in a bull market, and I have a 6% weighting in Bitcoin ETF. So I have 16% of my global equity portfolio hedging this dollar weakness.
Well,
unfortunately for Indian investors, there aren't any gold mining stocks in the Indian stock market because right now they're in a very good position. Gold's at all-time highs, and energy prices are low, which is their major cost. So they're making a lot of money, and they don't hedge the gold price anymore.
Absolutely, and there will be a lot of our viewers who would take note of these remarks, not just on gold, but Bitcoin, which also, from a direct opportunity within India, is barred by regulation. But what about silver, Chris? What's your view on silver?
Well, silver is high beta gold. So if you're an aggressive high beta investor, silver is an interesting speculation. But if I have 80% allocated to gold, or if I have let's say if I have an allocation to precious metals, maybe I put 10-15% of that in silver. Okay. But if I'm a very aggressive investor, I may choose to put 100% of it in silver.
Okay, 100% if you are a very aggressive investor. Let's quickly turn to the sectors that you have an eye on as far as India is concerned. IT is just one where AI seems to be having an impact. We are seeing what's happening in the domestic space there. But which sectors, according to you, offer a good opportunity in India at this point of time?
Well, so in my green for Indian portfolio, my various portfolios, I've always basically played India first and foremost as a domestic demand story. And at the end of the day, the economy is domestic demand driven, first and foremost, which is why these tariffs are not as big a deal as they could have been. I mean, for some countries in Asia, 50% tariffs would be a total disaster. So in that sense, I never really had a big exposure to IT services, but I would have to say that IT services, I think the software industry globally has to be a potential risk of disruption from AI. So in my Indian portfolio, I've always had a core position in the banks, but I think with this year, it's made sense to tilt it more to the various financial companies, financing companies, which are basically will be geared to lower rates and any pickup in consumption. Then I also think an ongoing theme is infrastructure plays. Airports would be one example. Then there's the travel. There's a whole overseas travel story and inbound tourism story, which I think continues to remain attractive. I think the whole cement sector is getting interesting because of consolidation. Then there's sectors which I don't have exposure to simply because I can't own everything because I have a concentrated portfolio. But clearly in the long term, the whole hospital healthcare story remains very interesting. And more recently, I think there's been more focus on the defense sector, defense stocks in the last couple of years in India, and I expect that to continue. So there's really a lot of themes one can play in India. This market is no longer just about IT services and banks, which was the main focus for about 20 years. That era is over.
It's interesting, Chris, you speak about defense because one of the largest orders of its kind in recent memory in India for next generation fighters could be placed on a French company, Rafale, early next year. But imagine if that was happening in India and what kind of upside it would have had. But what about new age consumption? Because um, you've added some of those stocks to your portfolio as far as the India picks are concerned.
Sorry, I missed that. Have I added?
Uh, I was asking you your views on new age consumption stocks like Make My Trip or Zomato um, as a future play.
No, I've had those in my for some time. Yeah. So yeah, those all make sense. Conceptually, those kind of stocks make sense. In the long term, the problem in India, if you've got a concentrated portfolio, of which I would define a concentrated portfolio as 20, 25 stocks, the biggest problem is what not to own.
Okay. Yeah, that's a fair point. As we wind down our conversation, Chris, I want to turn to your views on as far as earnings growth is concerned in India. What's your sense about
Well,
uh,
yeah, well, that to me really is all about we've got the pickup in nominal GDP growth. So, based on what my colleagues here are forecasting for next year, we're hoping for a pickup in earnings growth to the 12 to 15% range. But that's not going to happen unless we get the pickup in nominal GDP growth. So I
absolutely?
think that's, and clearly the earnings growth has been subpar relative to history this year, which is one reason the Indian, so 5-6% earnings growth in a market which is trading, even if you include the cheaper financials, at I think about 22 times forward earnings, leaves the stock market vulnerable on valuation grounds. And I think if
Absolutely.
you exclude financial stocks, the 12-month forward PE is like 25 times. So one would feel more, yeah, we need to see that pickup in nominal growth.
Okay. Uh, Let me turn to a final question and a broader question, and this is, your take on the India growth trajectory, particularly in the current government and the dispensation, a third term for Prime Minister Modi. Incidentally, Chris, he's celebrating and marking his 75th birthday today amongst one of the most popular leaders in Indian history. But very broadly speaking, and you looked at markets like ours for so many years, what's the broader 3 to 5 year view that you have as far as the India story is concerned?
Well, I mean, hopefully if we can get back to 10% nominal growth, which would probably be, 6% real GDP growth and more, hopefully, that India is on track. So I think that's an entirely realistic outlook. Doesn't require, extreme optimism. So that would be my base case. So I think there's some sort of particular, probably the biggest specific risk to the Indian economy is weakness is disruption on IT services.
Yeah, that's a very important
Now,
point you made.
now, a potential negative risk, which is not my base case, but should the U.S. president, for whatever reason, not do a deal with India on this tariff issue, contrary to the current hopes in the market, and then should he decide to focus on export of services, not just goods? Because I think when Donald Trump talks about trade, his conceptual focus is export of goods. But let's say he suddenly decides to focus on export of services. Let's say he suddenly gets told about these global capability centers. And let's say he doesn't like the fact that US corporates are employing thousands of people in India they could be employing in America. And he decides to impose a draconian tax on those US corporates that are doing that. That's the sort of news flow which could be very negative. I'm not predicting that, but I'm just saying that's a hypothetical outcome.
Well, it's something that's been spoken about in the US by some people within the administration and outside who are placed at different levels in the overall US establishment. And clearly, that is a big concern. And that point that you make about the India growth story, Indian IT has been a very, very crucial and key component of that. Chris Wood, thank you very much for your time. I'm sure all our viewers have uh, got some of the key takeaways from this conversation that will drive them hopefully towards sensible investing. Once again, thank you very much for your time with us.
Thank you.
With that, it's a wrap on this conversation with one of the most noted and famed equity market strategists, Chris Wood. We'll slip into a short break and come back after that to stay tuned in.